Welcome back to Invested, guys. I love this question because it talks about cap rate. Cap rate means capitalization rate. I love talking about this concept because people use it as a punchline, like brokers and everyone. The cap rate, cap rate. And this person asks, hey, is a cap rate valuation too simple of a valuation method? Yes, cap rate have been used forever, but knowing a cap rate doesn't account for debt service, capex, upcoming lease expiration, I don't understand why it is a technique most often used to find value of the property. Great question. I mean, a lot of people who understand cap rate might say, "Oh, this guy's question or this gal's question is so simple and so stupid." No, it's not. Real estate itself, like commercial real estate, I've been in it for about 20 years now, is very outdated. We always talk about in other videos, it's not creative. Look at the words, functional inefficiency. I mean, like, if you know the English word, what that means, that's what we use, right? And look at all the companies out there, Oak Tree, BlackRock. I mean, you add a wood, you add a stone, and you put capital, and there you go. And my company is the same way. So I'm not blaming them or saying anything negative because we're just not that creative. So when we talk about a capitalization rate, it's not a specific commercial real estate term. It's a financial term. So cap rates are used for multiple areas in investment, financing, and a lot of different analysis. So real estate people use cap rate because that is a standard to make everything equal, to get comparison apple to apple in a simple way. Because debt service, capex, expiration of the leases are unique to that property, right? And if you know financing or accounting, debt service is a unique thing under the NOI or EBITDA. Because what if I purchased the building all cash? Do I have debt service? I don't. But what if someone took 50% leverage at 8%? Or if someone took 60% at 5.5%? That's unique to the borrower. So how can we take all that comparison to make everything apple to apple? It's really not. So that's why in capitalization valuation we use is a quick check to make sure that asset's in line with that sub-market or the general MSA market. And what I'm trying to explain to you is if a property generates $100,000 of NOI, that's net operating income. That's your revenues minus your expenses. You get net operating income. Hotels, other business might use EBITDA, right? But similar concept. If you know the cap rate formula, you take the NOI and you divide it by the cap rate, 5%, 4%, 3%, 10%, and you get the value of that property. So I made it very clear. It's not free cash flow, right? Because that's unique to the owner of that property. So then how would you know you're overpaying or underpaying or you're getting a great deal or you're getting ripped off? You don't know. So when you're looking at something as an investor, it's a quick check. Hey, this building has $100,000 of NOI and they want a 6 cap, so they want XYZ. Well, the market there with that sub-market, you should be trading at a 7 cap. So is a tenant have a stellar credit or do they have a longer walk than the sub-market in general? So they use cap rate and sales comp per square foot, per bed, or per unit, depending on what asset, to kind of see the value is in line with that market. Then once that's in line, you're like, oh, let me dig through further, and you can do the valuation in greater detail. If no one does any valuation and just buys property based on cap rate, they're going to be losing money. A lot of times. Maybe you hit a home run. I don't know. But most of the time, you have to do your due diligence. I'm not saying technical DCF model 10-year pro forma is better than a gut check. It's not. I mean, I don't even know what's gonna happen tomorrow. I don't even know what temperature. I mean, I may know because the calendars and the weather tells you, but I'm not gonna even know what happens tomorrow, let alone 10 years. So pro forma is the best estimate based on today's patterns and assumptions and thesis. So that comes with a lot of experience. So you use that to underwrite the deal, to spot check. Hey, they wanted a 6 cap, but they'd say NOI was 100,000, but that's incorrect because there's this leakage. These guys are not paying property manager because they're operating themselves, but industry standard, got to put in at least 3% of property management fees. So true NOI is essentially 950,000, and the cap rate is not 6 cap in the market, is 6.5 cap. So now I'm gonna put my offer in based on $950,000. divided by 6.5 cap. So here's my offer. That's how they utilize cap rate. And also cap rates are used for future valuation. So essentially, if I'm buying something and if I'm going to be adding value to it by increasing the leases, mark to marketing the rents over the 5 years, curating better tenants, which increase the credit value of my property. So now 5 years down the line, what can I sell it for, right? Since I have a better credit, instead of having Charles Kim's Burger Shop, I brought in and out, right? Same burger shop, let's say they pay the same amount of rent, better credit. So that's going to compress my cap rate slightly better compared to the market. So then you have to kind of assume what's going on in 5 years. Interest rate right now is, let's say, 7% or 6%, whatever you want to say. In 5 years, I believe, using assumption, I'm going to unwind that interest rate down from 7% to 6% because we think, the Fed's going to lower the rates in 2 years, blah, blah, blah. Therefore, cap rates are directly correlated with the interest rate, so that at that time, I believe I can sell this for 5.5 cap. Maybe we sell it for I bought it for 6.5, I sell it for 6.25, right? So that's assumption that people usually make to come up with the valuation of what the property is worth today in place and pro forma cap rate when I exit in 5 years or 7 years. Because if you're a syndicator or if you're even a family office, your investors, your principals, or person you work for is going to need to know how much money they're going to be able to make with their investment. So that's long way when that capitalization is way for. It's a very simple, but also very complex if you really dig through it further. Because cap rate is not just what I gave you, the formula of NOI divided by cap rate. The cap rate takes into supply and demand, absorption period, interest rate, market sentiment, the demographic. It's just a lot of component that goes into it. So it can be very complex, a tool to use from an underwriting perspective or your financial model. So hopefully that answered your question. And if you have any other questions, we love to gain questions. So please add it to the comments. We'll address it for you. If you found this content helpful, please like, subscribe, and share. Thank you very much.